Sarah paid her credit card every single month. Never missed a payment. Not once. For 3 years straight, she sent in $340 a month, like clockwork. In her mind, she was doing the responsible thing, paying her bills, being a good adult. So imagine her face when she finally pulled up her full statement and realized she had paid over $12,000 and still owed almost as much as when she started. $12,000. Gone. And her balance barely moved. She wasn't reckless. She wasn't overspending on vacations or shoes. She made one quiet mistake. The same mistake that's happening right now, in the background, in almost every American household. It doesn't show up as a dramatic moment. It shows up as a number that just never seems to go down, no matter how responsible you feel. By the end of this video, you're going to understand exactly what a liability really is, why some debt is quietly bleeding you dry, while other debt can actually work in your favor. And the one number you need to check today to find out if you're in Sarah's situation right now without realizing it. Let's break it down. Here's the uncomfortable truth. Most people think debt is one single thing. Either you have it or you don't. Either you're bad with money or you're good with money. But that's not how it actually works. Not all debt behaves the same way. Some debt sits quietly and grows, feeding on itself. Other debt can actually help build your future. The problem is, nobody sits you down and teaches you which is which. So people do what Sarah did. They just make the minimum payment month after month and assume that paying something means they're making progress. Here's the part that should genuinely alarm you. According to Federal Reserve data, Americans are now carrying nearly $1 trillion in credit card debt combined. Not because people are irresponsible, but because almost nobody was taught how interest actually works against them. This video is about fixing that gap. Let's start with the real definition. A liability is simple. It's anything you owe. Any money that legally belongs to someone else and that you're obligated to pay back. That's the definition. But the number on your statement isn't the whole story. What matters just as much is how that liability behaves over time. Here are the common categories: credit card balances, any amount you're carrying month to month, not paid off in full, loans, car loans, personal loans, payday loans, any borrowed money you're paying back, student loans, money borrowed for education, still outstanding, mortgage, the remaining balance you owe on your home, medical bills, any healthcare costs you're still paying off, unpaid bills, utilities, subscriptions, anything overdue. Now here's the sentence I need you to hold on to for the rest of this video, because it's the difference between debt that helps you and debt that quietly destroys you. The danger of a liability isn't just the amount you owe, it's the interest rate attached to it, and whether that debt is helping you build something or just disappearing into nothing. That single idea is exactly where Sarah's story goes wrong. Sarah's credit card had a balance of around $6,000. Nothing crazy. A rough year, a car repair, a few emergencies that piled up. Here's what she didn't fully understand. Her interest rate was 24%. Not $24. 24% every single year, compounding. She was paying $340 a month. Felt responsible. Felt like progress. But here's the math nobody showed her. At that interest rate, more than half of every single payment she made was going straight to interest, not touching the actual amount she owed. The bank wasn't just being paid back. The bank was making money off her every single month, faster than she could pay it down. This is called the debt trap, and it's not a metaphor, it's math. High interest debt, left on a minimum or near minimum payment, can grow almost as fast as you're paying it, sometimes faster if new charges get added. Compare that to a completely different kind of liability, a mortgage. Say Sarah's parents have a mortgage at 6% interest. Every payment they make is mostly going toward an asset that's typically growing in value over time, the home. That's a liability too, technically, but it behaves completely differently than a 24% credit card. It's working with them, not against them. This is the distinction almost nobody explains. Not all debt is equal. A mortgage or a reasonable student loan for a career that pays well can be a tool. A high-interest credit card sitting at a minimum payment is a trap, quietly working against you every single month, whether you notice it or not. Sarah didn't do anything reckless. She just never saw the difference because nobody ever broke it down for her the way we just did. So what changed? Sarah didn't get a second job. She didn't win money. She did one specific thing. She looked up the actual interest rate on every single thing she owed and wrote it down next to the balance. Suddenly, the problem wasn't invisible anymore. She could see it in black and white. The credit card at 24% was the fire that needed putting out first. Everything else could wait. She used something called the Avalanche Method. Instead of spreading her money evenly across every debt, she paid the minimum on everything else and threw every extra dollar she had at the highest interest rate debt first. Once that one was gone, she rolled that same payment onto the next highest. She also called her credit card company and asked, directly, if her interest rate could be lowered. It sounds simple, almost too simple, but it worked. They dropped her rate by 6 points just because she asked. 14 months later, that $6,000 balance was gone, not reduced. Gone. And for the first time in 3 years, her monthly payment wasn't disappearing into interest. It was going into her own savings account instead. Here's exactly how to check your own situation right now. Step 1. List every single thing you owe. Every card, every loan, every balance. Don't skip anything, even the small ones. Step 2. Next to each one, write down the interest rate. This is the part almost nobody does, and it's the part that matters most. You can find it on your statement or by logging into your account. Step 3. Sort the list from highest interest rate to lowest. Whatever sits at the top of that list is quietly costing you the most every single month, regardless of the balance. Step 4. Pay the minimum on everything except the top item. Put every extra dollar you can toward that one. Once it's gone, move to the next. And one more thing that takes 5 minutes and can save you real money. Call whoever you owe the highest interest debt to and simply ask if they can lower your rate. It doesn't always work, but it costs nothing to ask. And sometimes, like Sarah, it works better than you'd expect. One important note. This video is about understanding and managing debt you already have. It isn't a replacement for advice from a licensed financial advisor or credit counselor, especially if your situation feels overwhelming. There's no shame in reaching out for that kind of help. Sarah's story isn't really about a credit card. It's about a number that was working against her, silently, for 3 years. Not because she was careless, but because nobody ever taught her to look past the monthly payment and check the interest rate underneath it. That's the gap this video just closed for you. So before you close this out, go find your highest interest rate debt right now. Just find the number. That's the whole assignment for today. In the next video, we're going to put assets and liabilities together and calculate your full net worth. The one number that tells you exactly where you stand and exactly what to fix first. If this changed how you see your own debt, hit subscribe so you don't miss it. And drop your highest interest rate in the comments. No judgment, half the people watching are dealing with the exact same thing. I'll see you in the next one.